Welcome to the deep dive. There's uh, a really high-stakes economic dance going on right now. It could reshape a vital international partnership and, well, directly impact thousands of lives.
It really could. What we're diving into today is the U.S.-Kenya Strategic Trade and Investment Partnership, STIP for short. These are the formal negotiations, back on the table, the bilateral trade talks everyone's watching.
Exactly. And our mission today is to cut through all the noise, find those essential nuggets of knowledge for you. We'll take you through the sources, help you understand why these talks are happening now, what's genuinely at stake for both Kenya and the U.S.
And what it means for things like market access, investment, and just the overall strategic relationship.
Yeah, think of it as your shortcut to getting really well informed on this crucial topic.
And if you look at what's driving the urgency, two pressures really jump out immediately. First, there's this significant uncertainty hanging over the future of AGOA.
Right, the African Growth and Opportunity Act.
Exactly. That's what gives duty-free access for, eligible African exports to the U.S. market right now. Without a clear path forward there, a lot of industries they're on edge.
And the second thing, just as pressing, is the recent shifts in U.S. trade policy itself. We're talking new tariffs, a bigger focus on diversifying supply chains, resilience, maybe even reshoring some production.
So both sides have a very real, very immediate reason to try and get this particular deal done.
Okay, so to really get what's happening today, we need to look back a bit, right? This isn't entirely new.
No, not at all. We're actually seeing a sort of reignition of talks that kicked off a few years ago. Formal negotiations were first launched, I believe, in 2020. That was under the Trump administration.
Right.
And the core idea then, much like now, was to build a deeper bilateral trade and investment framework, something to complement regional integration efforts, not really replace them.
So it's more of a continuation, not just a sudden thing. The U.S. Trade Representative, the USTR, and Kenya's Trade Ministry, they've been holding rounds of talks since then.
That's right. Iterative rounds. And Kenyan reports, from local media, trade watchers, they talk about multiple in-person rounds. Ministers over there have been saying talks have inched closer to completion just recently in 2024, 2025.
Which really shows how active things are right now.
It's a critical point. The timeline confirms it. You had early rounds, 2020 to 2022, then more rounds through 2023, 2024. And USTR has been putting out public summaries in 2024 and 2025. So this is a sustained, official government-to-government thing, not just exploratory chats.
Okay, let's zoom in then. What's the core motivation? What does each side really stand to gain or, I guess, lose here? For Kenya, this feels huge. It's not just numbers, right? It's livelihoods.
Absolutely. Their aims are pretty clear. Look, they're fighting to protect thousands of existing jobs, especially in sectors like apparel, hosiery, horticulture. These industries really depend on that U.S. market access.
So they need to institutionalize that access, try and minimize the shock if AGOA does lapse or change significantly. It's defensive, in a way.
It is, partly. But they're also looking forward. They definitely want to attract more U.S. investment, particularly in manufacturing, maybe supply chain relocation. And they want commitments on rules that make business easier, streamlined customs, clear procurement rules, IP protection.
Okay.
And crucially, they're pushing for rules that fit their development needs. Things like flexibility on rules of origin we can get into, that may be transitional arrangements so changes aren't too abrupt.
Like a gradual ramp up.
Exactly. And capacity building support, maybe help from the U.S. to meet new standards, whether it's training or infrastructure. It's about building for the long haul.
Got it. And on the U.S. side? Equally strategic aims, I assume, but maybe a different angle?
Yeah, a different flavor, as you said.
Yeah.
The U.S. wants to diversify and secure its supply chains. Textiles, critical inputs, agro-processing.
Yeah.
It's about reducing dependency on, just a handful of suppliers, making trade routes more resilient.
That makes sense.
And our sources, USTR summaries, stakeholder comments, they consistently emphasize things like labor and environmental standards, digital trade rules, investment rules, market access for services, investment protection, government procurement. It's about setting a certain standard for trade deals.
But then there's the domestic politics angle in the U.S., right?
Yeah.
That always plays a role.
Oh, absolutely. It's fascinating. You have lawmakers in Congress, for instance, who are pretty skeptical about certain investor protection clauses. They want really strong, enforceable labor and environmental safeguards baked into any deal.
So the USTR is kind of walking a tightrope, negotiating overseas, but always looking over their shoulder at Washington.
Exactly. It's a constant balancing act. You need a deal that works strategically for the U.S., but If it can't get through Congress, if it's not politically palatable back home, well, it's dead on arrival. We've seen that movie before with other trade deals. Internal disagreements can really shape the outcome or even sink the whole thing.
Okay, so with all these goals, what are the actual, like, sticking points? What are the specific issues they're hammering out right now?
Well, the fundamental one, the absolute bedrock, is market access and tariffs. The big question is, what tariff schedules apply? Does Kenya keep that critical duty-free treatment, especially with AGOA potentially running out?
Because if that changes,
The whole economic calculation shifts overnight for a lot of Kenyan businesses.
right. And closely related, or the rules of origin, you mentioned those.
Yes, crucial for sectors like apparel and textiles. These rules basically define how much of a product's inputs have to come from Kenya, or maybe the region, to qualify for the special treatment, the duty-free access.
Sounds technical, but it's huge.
It is. Get those rules wrong, and an entire industry might struggle to compete, even if they technically have duty-free access on paper.
Okay, what else?
Then you've got that bundle: labor, environment, and regulatory coherence. U.S. negotiators tend to push for enforceable standards here. And as we said, some U.S. lawmakers push back hard on investor protections if they think they might undermine these standards or a country's ability to regulate for its own good.
Which brings us to investor protection itself. How are foreign investors protected? Does this deal include ISDS, investor-state dispute settlement? That's always controversial.
It is politically charged, absolutely. ISDS allows foreign investors to potentially sue governments directly over policy changes. Some argue it's essential to protect investments and encourage capital flow.
While others see it as undermining national sovereignty or the ability to regulate health, safety, the environment.
Precisely. It's a major point of contention in many trade talks. And finally, you have services, digital trade, data flows. These are increasingly big items. The U.S. often pushes for digital trade rules that allow data to flow across borders more easily and open up access for service providers. It reflects the digital economy's growing importance.
Okay, let's talk impact. The real economic stakes, the human element. You mentioned AGO supporting thousands of Kenyan jobs, especially in apparel.
Yes, share of export-related manufacturing jobs in Kenya are basically at risk if that duty-free access disappears. This isn't abstract economics. It's about people's livelihoods, families relying on that income.
It's a very real human consequence.
It is. But what's also interesting is you hear some Kenyan officials, some industry folks, seeing the recent shifts in U.S. tariff policy, the supply chain focus, as maybe an opportunity.
How so?
They think if Kenya can get its costs down, consistently meet U.S. standards, it could actually win new sourcing contracts, attract business that might currently be going elsewhere, help shift those global supply chains a bit.
But that's a big if, isn't it? There are real challenges to Kenya's competitiveness that need tackling at the same time.
Absolutely. That's the immediate balance. Imagine trying to compete globally if your factory's electricity costs are double your competitors, or getting goods to port takes days longer because of infrastructure. These aren't small things. Electricity costs, taxes, wages, logistics, they're fundamental hurdles.
So even a great trade deal on paper needs that supportive environment on the ground to really work.
Exactly. You have to address those constraints, too, for the benefits to really flow.
Okay, connecting this to the bigger picture then. The political context, the timing pressures, they seem huge here.
Undeniable. AGOA's authorization, its renewal window, that's a critical countdown clock ticking. Both sides have signaled they really want to get these trade questions sorted before the AGOA rules potentially change or expire, because that creates a massive cliff edge for businesses.
And then, back in the U.S., domestic politics again. Congressional scrutiny, especially on things like investor protection, plus U.S. election cycles. That can really squeeze the timeline, right? Or just make approving a big deal much harder.
For sure. Getting any major legislation through Congress is tough. A complex trade agreement, even tougher. These external factors can definitely impact the pace and substance of the negotiations.
So who are the actual players at the table? Let's map that out.
Okay, on the U.S. side, you've got the USTR leading the charge. They hold public summaries, stakeholder listening sessions, try to get input, but they're not alone. Agencies like Commerce, State, Labor are involved too, and critically, Congress. They have oversight and ultimately the power to approve or reject. They're the gatekeepers.
And on the Kenyan side?
You're looking at the Ministry of Investments, Trade and Industry, the Cabinet Secretary, and their negotiators. The presidency is also key, providing strategic direction. And, of course, the private sector groups, exporters, the Manufacturers Association. Their input is vital because it reflects the realities on the ground for Kenyan businesses.
Okay, looking ahead then, what are the main risks? What could derail this whole thing?
Well, the most immediate risk is probably AGOA expiring without a replacement deal or at least some kind of bridge measure in place. That would instantly change the economics for those AGOA-reliant firms. Potentially overnight, businesses would be scrambling.
I'm back in the U.S.
Domestic opposition. If there's strong pushback against, say, investor protections or other specific provisions, it could force negotiators to heavily redraft the agreement or maybe even kill parts of it. You could end up with a much weaker deal than intended.
And the third risk we touched on.
Yeah, Kenya's own competitiveness constraints, high energy costs, taxes, regulatory bottlenecks. If those aren't tackled in parallel through domestic policy, they could really blunt the benefits of even a good trade deal. You need both things working together.
So given all that, what are the likely scenarios? How could this play out?
Well, let's think best case. Negotiators agree on a solid STIP package, maybe something like a free trade agreement, or at least a clear path for market access. The U.S. Congress and administration find a way to implement it that's politically acceptable, and AGO gets extended or bridged while that happens.
That sounds like the win-win. Protects jobs, unlocks investment.
Pretty much. Then there's maybe a middle case. Perhaps they reach a partial agreement, focus on investment rules, regulatory cooperation, maybe a temporary market access deal, while AGOA gets a short extension to allow more time for full negotiations.
Keeps things moving, buys time, but doesn't solve it all immediately.
Right. And then the worst case. That's where AGOA lapses or gets significantly cut back, and the bilateral deal stalls or gets seriously watered down because of U.S. domestic politics.
And the impact there.
Kenyan exporters face tariffs, lose competitiveness. That likely means job losses, economic strain. It's the outcome everyone wants to avoid.
So for you listening, what should you watch for to see which way things are heading?
Keep an eye out for new readouts or public summaries from USTR after negotiation rounds. They're usually posted online and give clues about progress or lack thereof.
Also, watch for statements from the Kenyan government. Are they announcing next rounds? Are they talking about domestic policy changes, tax, energy, logistics aimed at boosting competitiveness? That shows they're serious about the groundwork.
And, of course, any signals about AGOA coming out of the U.S. Congress are their hearings, are renewal bills being introduced. Even talk about short extensions tells you something about the political mood.
Finally, what about the private sector?
Yeah, watch their reactions. Are companies placing big orders, announcing new investments, talking about factory plans? Those would be the early green shoots, suggesting businesses are feeling confident that preferential access will continue and they can plan for the future.
Okay, so let's bring it all together. The bottom line for you, our listener.
Look, these renewed active trade talks between Kenya and the U.S. are really consequential. They genuinely have the potential to lock in stable, preferential market access, maybe a new investment framework that could effectively take over from AGOA.
Or, the flip side, they could fail to prevent major disruption if AGOA lapses and those political headwinds in the U.S. block a comprehensive deal.
Right. For Kenyan policymakers, Kenyan exporters, the priorities seem crystal clear. Defend that market access, or at least get a credible bridge. Tackle those domestic competitiveness issues we talked about, and use this negotiation window right now to try and attract that longer-term manufacturing investment.
It really makes you stop and think, doesn't it? How these seemingly technical details, rules of origin, digital trade rules, how they can actually shape the day-to-day lives and livelihoods of thousands of people in Kenya.
Absolutely. You hear stories like a small artisan group whose entire business model hinges on one specific customs classification. It makes these abstract terms incredibly real, very human.
And what does that tell us about the often hidden human impact of these big global trade negotiations, usually buried under layers of economic jargon? You have to wonder, what other bilateral trade talks out there might be facing similar kinds of pressures right now? And could they maybe learn something from what's unfolding between the U.S. and Kenya? Something to think about.